Welcome to Stewardology, a podcast where two worlds collide. In this show, financial advisor Tim Russell and Reverend Drew Gysi come together to explore the intersection of financial stewardship and theology. Their unique perspectives help Christians and churches understand and apply a biblical framework for everyday financial decisions, so Christians everywhere can improve and strengthen their walk with Christ through biblical stewardship. Before we get started, we just wanted you to know that the topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. Securities and advisory services are offered through Genuous Wealth Management, member FINRA and SIPC. Without further ado, here are your hosts, Tim Russell and Drew Gysi.
I'm Tim Russell.
And I'm Pastor Drew Gysi.
And we welcome you to episode 108 of
the
Stewardology Podcast.
Well, Tim, to start off this episode, I would like to read a very, very well-known passage of Scripture. And it's just one verse, and this is what it says. Jesus said to them, "Render to Caesar's the things that are Caesar's, and to God the things that are God's." And they marveled at him. Mark 12:17.
Interesting.
Well, Tim, when we do our seminars across the country, one thing we like to say in conjunction with this passage is, render unto Caesar's what is Caesar's, but not a penny more. That's actually in the fine print of the Greek. I know you're a Greek scholar, Tim.
Well, yeah, I'm not sure if that's a variant or what that would be.
But it's tucked in there somewhere. Is
that first Drew, second or 2:15?
No, I think it's 1:15. So you got to get in the right one there. So, but the bottom line is the episode today deals just with what we talked about, paying our taxes, but not unto Caesar, unto Uncle Sam, for those of us here in the United States. But we want to make sure that we are not paying more than what we ought to. A good steward will be proactive, not just in their income and expenses, but also making sure that they pay what is needed and necessary for their taxes. Yeah. And not a penny more.
So, yeah, taxes are such a touchy subject, right? We hate having to pay taxes. Oh. And yet we understand that they are an essential part of being able to run the country. We would not have roads and highways had there not been a taxing authority with the revenue to be able to build those things. And without those things, we would not be able to be successful as an economy, right, or as businesses and individuals. So we recognize there is good with the bad. And obviously there's plenty of bad with taxes because we see the waste and the abuse and the manipulative, grubby, get your grubby paws off of the money kind of a thing when there's envy and greed driving the taxing decisions that people make. So how do we as Christians think about taxes in general, and specifically, how do we make sure that we're not paying to Caesar more than we have to?
And it's good, like you said, Tim, that we pay our taxes for the roads, for all the other things that we get within our society. But for those that are listening, they're probably very kingdom-oriented, not kingdom of earth, but kingdom of heaven-oriented. And if we could make sure that we pay just what we need to, and not a penny more, then we could redirect, instead of to Uncle Sam or to the country of where you're living, because we do have an international audience here, you could wind up putting more towards God's kingdom building purposes instead of this local kingdom here on earth. So that's what we want to talk about today. So, Tim, why don't you start us off? There's something new that's just happened here in the United States. Talk about this crazy thing that's happening.
Well, a recent regulation, I think it was the Let's Fight Inflation Act. Let's all get together and beat it up. Of course, the act has absolutely nothing to do with inflation and has absolutely nothing to do with lowering inflation. In fact, many of the things that the legislation proposes would actually increase inflation. So, that's Congress speaking out of both sides of its mouth.
Yes.
But specifically to our topic today, one of the points that got a fair amount of press was that the IRS is hiring something like 87,000 new agents or new employees to help staff the IRS.
That's crazy.
They
number.
Also...
That's a crazy number.
Well, so it is and it isn't. It is and it isn't. And I'll explain why in a minute. But they also purchased a significant amount of guns and ammos so that some of their revenue agents who are going out to make sure that we're able to collect the government can collect the funds that are owed to them can be protected against bad taxpayers or tax cheats, and as the case may be.
So we have the Army, the Air Force, the Navy, the Marines, the Coast Guard, the Space Force, and now the IRS?
The tax force, yes.
The tax force. So
the Revenue Confiscation Force.
So, but
RCF.
I think you said earlier, we were talking about this, that they have the guns but no sense of humor, right?
Oh, my goodness. Yeah, please. No IRS jokes. They might shoot you.
Well, let's not do that because I don't want that to happen.
So that's should we be worried?
That's the question at hand, because you just talked about 87,000 new IRS agents coming on board here. Should we be worried?
No. The first answer is no, we shouldn't. Actually, to some extent, we should be a little bit encouraged because there are a couple things that are going on. First of all, the IRS is an aging agency. Aging not just in terms of how long it's been in existence, but aging in terms of the population of its workforce. In fact, it is estimated that something like a third of the population is probably going to retire in the next 5 to 10 years.
Really? A third?
Yeah. Yeah. So if you think about just this 87, that barely keeps up with attrition. And we have seen significant attrition in their customer service and their revenue agents and their various auditors, so that the amount of work that theoretically, the amount of work that needs to be done is being done by fewer people who are overworked and underpaid and who are saying, you know what, during this great resignation, I'm going to go find a job somewhere else. Yeah. So they're able to do that. And that, that has led to a significant amount of problem. So the other factor is customer service. It has been absolutely terrible.
It's beyond terrible, Tim.
So if you call the IRS and you try to have a conversation with someone, you have to be on hold for hours before you're able to get an agent, and then the agent's poorly trained and doesn't know how to address the issues. They really have to beef up the customer service wing. It's not just about paying taxes. It's about having a better experience when even trying to get a refund or doing the things that you need to do, correcting a problem, getting an answer to a question, or telling the IRS information that they were asking for in a letter to you. Yeah. All of these things can be just made so much more frustrating when they don't have the people necessary to answer the phones and just to keep the place running.
My daughter had a hiccup with her taxes, I think a year and a half, 2 years ago.
During COVID, yeah.
Yeah, and it took over 18 months to get it all clarified. It was a simple mistake that happened. It wasn't anything large. It was just numbers that were just not put in properly. We got it corrected, but it took over 18 months. And I contribute that specifically to poor staffing with the IRS. So it would have been nice to make a simple phone call, get it all corrected, get it all done, and put it behind us, but it took so long.
Yeah. So should we be worried about increased IRS audits?
That's a great question. And I will tell you, I've talked to some people, and that is a fear when they hear this 87,000 new IRS agents. They're thinking, they're coming after me. So what do you think, Tim? I mean, you understand the pulse of some of this stuff. For the common folk, what are some of the numbers that are out there?
Well, so the fear of audits may be significantly overblown, right? There are only about roughly 500 give or take, auditors in the tax compliance office. And that's as of 2019. Okay.
So that's before this resignation.
Before the great resignation. That's right. That's right. One auditor might be performing 10 to 20 audits a year. Okay. So that's not a ton of audits.
That's not a ton of audits.
Because it takes so much time in order to actually process through some of these audits. Sure. And again, it depends on the level of audits that they're doing. And we'll talk about that in a minute. The IRS workforce went from 11,000 to 8,000 people over the last decade.
That's a significant drop.
So that's why I'm saying when we're looking at hiring these agents, it's going to cover some of the attrition and get them back to where they need to be.
Do you by chance know when the IRS was at their peak, fully staffed? Do you have any idea?
I have no idea.
I'd be curious to find that number out. If by chance you're out there and you know that information, send us an email. We'd love to know that.
So the other factor here is that not all audits are the same. In fact, there is a significantly higher number of audits for people on the low income side of the spectrum than there are for people on the high income side of the spectrum. Now, our liberal friends out there in liberal media land would like for us to know that there's some kind of income bias against poor people. It's simply not, actually. What they're doing is they're auditing one of the tax angles, one of the tax benefits that we provide to people called the earned income tax credit, which is subject to a great amount of fraud.
Yes.
So if you are of a low enough income, you get a refundable credit for being low enough income, so you pay no taxes. And we have a number of people filing these tax returns to collect the refund for people who have deceased or for people for whom they've stolen Social Security numbers and all of that. Yeah. So there's fraud going on, and the IRS runs hundreds of these audits a year just to verify whether or not it's true. And it's not like a whole sit-down audit. They can do this from a computer terminal, and it can be done in the course of a couple minutes. It's not something that's massively invasive, right, or something that is in some way trying to victimize or target low-income people because they're low income. Sure. It's trying to limit the fraud in a government benefit that's geared towards low-income people.
Sure.
Okay, so that's the vast majority of audits are in that world. The rest of the audits tend to be on individuals who make more than $250,000, $300,000 a year or more. They focus on a number of things. So here, what causes you to get audited?
That's a great question.
So what causes you to get audited? There's a number of things. So according to an study from the U.S. News and World Report, here are some of the reasons why people are getting audited. Well, number one, you don't record all of your income.
Yeah.
So this would be you got a 1099, you forgot to tell your tax preparer about it. The IRS is going to send you a notice. It's not technically an audit, but they'll send a notice, say, hey, actually, you owe us more money.
Exactly.
So you'll have to go back, find that 1099, add it to your return, amend it, and pay the tax and penalties. You could have a home office deduction. You took a home office deduction for self-employed individuals.
And there's specific rules and regulations for having a home office that you have to abide by. Yes. I know I did for years when I was pastoring, and it worked phenomenally well, but I had to abide by the letter of the law of how I used that.
Yeah. So you report business losses. If you're taking a business loss, that's an area where there's potential subject for people to fudge the truth.
Yes.
Or you have unusually large business expenses. You had maybe you failed to report all of your stock trades, or you did not report cryptocurrency payments or income or profits or gains. You had extremely, or maybe I should rephrase that, you have larger than anticipated charitable contribution deductions.
Let me throw one in with that. And it may not be just a large number, but it's a large percentage compared
That's actually, I'm going to circle back to that one, because that's probably the biggest one of all of these.
Because my wife and I had to deal with that.
Yeah. You earned a lot of money. So if you have a high income, you are going to be more likely to be a higher target, and you made an error in the reporting. These are all the various things that the U.S. News and World Report says audits are coming from. Going back to perhaps the most significant cause of audits tend to be focused more around your charitable contributions. So it's not just that you made large charitable contributions, it's that the percentage of charitable contributions relative to your income is out of proportion. So here's an example. You're giving 5% of your income year after year after year, and all of a sudden one year you give 30%. Mm-hmm. Your income is staying about the same, but all of a sudden your charitable giving jumped up. That's going to be a red flag.
Right.
What's going on? Now, guys, if you're given less than 5, yes, you need to step it up, and don't worry about that being a red flag.
Right.
I would love for you to be giving closer to 10 or above. But it's when there's that substantial percentage jump that just flags the IRS. Now, don't worry about that. If you're doing true, honest, charitable contributions, just keep your receipts.
Exactly.
Have your canceled checks, have your bank records that show the thing, or have the donation receipts from the charities. Keep those. Just the IRS agent's going to show up. They're going to say, hey, I'm really curious about these charitable contributions. Do you have your receipts? You show them the receipts, say, oh, thank you. That's great. Thank you for your generosity.
Have a good day.
And they'll move on. Oftentimes, it's not a witch hunt.
Right.
They have a couple questions they want to know, and if you answer those questions and don't give them a ton of extra data that's going to make them start fishing in other areas, they're generally going to let you go because they're interested in closing that case, wrapping it up to get their numbers where they need to be. They can keep on moving. 2
things to kind of tie in with that. My wife and I used to use TurboTax for years. And as we used the TurboTax, when we were going through and doing the putting our charitable contributions in there, it was every single year, Tim, we would get to a point and there was literally this red flash across the top of the screen toward the end. It says, you will be audited, because our percentage was very high. It didn't matter whether it was percentage pertaining to the previous year or whatever, but it made it very clear. You will be audited. That brought fear to us in that. But you said something very, very important, Tim. Have the receipts. Have that information.
Yeah.
That's the critical piece to do things. Be charitable. We encourage that greatly.
Yeah.
Just have a tracking method.
The biggest area that the IRS is looking for are non-cash contributions.
Yes.
How did you value your non-cash contributions? If you're given $50 worth of clothes to the Goodwill, they're not caring about that.
Not worried about it.
They're caring about like donating a car or a boat. Did you get it appraised? How did you assess its value for the donation? Are you following the rules? Did you donate artwork? Did you follow the rules to get the appraisal so that you have a documented number for which you can deduct? Those are the things that they're most interested in. If you're doing cash contributions, you're going to have a receipt. It'll be easy to track that down. Don't worry about it. Now, non-cash is where the problems are.
Now, Tim, we talked about this before offline. The IRS has to audit using a cost-benefit perspective.
That's absolutely true.
Explain what that means, cost-benefit perspective.
Okay. So why are they focusing on medium to larger taxpayers rather than the small guys? If they're auditing someone who has maybe underpaid their taxes by $100 to $1,000, and the auditor's time in researching and doing all the paperwork and doing the findings, the audit itself, we're pushing 20 to 40 hours.
Mm-hmm.
Okay. The cost and salary and resources of that individual versus the potential revenue gained by stopping that person from underpaying taxes has a cost-benefit analysis that says it's probably not worth it. Now, when you look at someone making hundreds of thousands or millions of dollars a year, and we're talking about potentially underpaying their taxes by many thousands upon thousands of dollars, maybe even hundreds of thousands of dollars underpaying taxes, you look at that cost-benefit analysis and says, yes, it's worth the time. If we think there's something going on there, it's worth the time to investigate that, because from a cost-benefit analysis, we're going to make our money back on that audit if we're right.
What is, when you were saying people that are making more money, what would you say is a good dollar figure of these higher risk people being audited? You ran some numbers earlier. What would be a good number?
I mean, so north of 400,000 is probably a good number. That's the specific number I think that Biden and all of his pundits have been banting about with this new IRS revamp. They said, hey, we're not targeting the little guys, just the people who are not paying their fair share, 500, 400,000 and above.
And that is that for a couple or for an individual, or it didn't matter?
That's actually married joint.
Married joint. Okay, so that's good to know that.
So if you're a single individual making a little less, it's possible you may get audited still. But again, it's not likely. And it's not highly probable that any one individual is going to get audited.
And that's what I wanted to come to next. It's very unlikely you're going to get audited, especially if you are continuing to honor the Lord and do what is right with your taxes. And isn't that what we ought to do, each and every one of us? Commit to paying your fair share, what is right, what is honorable. And isn't that what Jesus specifically did? We see here when he paid the temple tax. Let me read, starting in verse 24. It says, after Jesus and his disciples arrived in Capernaum, the collectors of the 2 drachma temple tax came to Peter and asked, doesn't your teacher pay the temple tax? Yes, he does, he replied. When Peter came to the house, Jesus was the first to speak. What do you think, Simon? He asked. From whom do the kings of the earth collect duty and taxes? From their own children or from others? From others, Peter answered. Then the children are exempt, Jesus said to him. But so that we may not cause offense, go to the lake and throw out your line. Take the first fish you catch, open its mouth, and you will find a 4 drachma coin. Take it and give it to them to pay my tax and yours. Hey, Tim, just letting you know, I'm cutting out the podcast right now. I'm going fishing.
So you have a big tax bill?
I don't think so, but if the fish got coins in them, I'm going fishing. Do they have Bitcoin? Is that what they have in there?
Yeah, I think the fish is
the
Bitcoin.
fish has Bitcoin.
It's getting less and less every day.
You know, here even Christ, who was and is not a citizen of this world, of this land. He's a citizen of heaven, just like all of us as believers. Yet he chose to do what is right and honorable and make sure his taxes were paid. Mm-hmm. So let's all of us as believers in Christ consider and make sure that we're honorable and upright with our taxes. Now, I want to kind of switch our gears here. Our topic is don't tip the IRS. We've just covered a lot of tax stuff. What do we mean by tipping the IRS, Tim?
Well, I think the idea is that we're paying more to the IRS than we need to pay the IRS. So paying more tax than is required, not taking advantage of the legal tax benefits that we're entitled to.
Yeah. One of the things that when we sit down and we talk to somebody and we look at their tax return and they're consistently getting a refund year after year, we want to take a look and see what causes that refund and how do we go about reducing that refund.
Yeah, so in the category of don't tip the IRS, we're thinking about it in maybe 4 different ways. The first way, as Drew just alluded to, is getting a significantly large tax refund may be a poor stewardship benefit. So here's how is that tipping the IRS? Well, they have an interest-free loan for maybe up to 12 months that they get to keep, pay you no interest on. So if you paid them $5,000 more than you needed to, they get to keep that money. They get to have the benefit of that money and then give it back to you later with no interest. That's a problem. We do recommend at this point, look at your tax return or how much are you getting back each year? Are you paying taxes? So this is where you would look at the second page of your tax return. If you need help with this, you can reach out to us. We can walk you through it. But look at your second page of your tax return. Look at the actual amount of taxes paid. This would be like from W-2 withholding or 1099 withholding or maybe quarterly estimated tax payments. Right. Those are the 3 main sources where taxes are being paid. So you look at that and then you look at your refund. If your taxes paid are more than you need to pay and you're getting a large refund, you would want to reduce your tax withholding at work or on your 1099s or your estimated payments so that you're not giving the IRS more than is required. You may want to take that number, divide it by the number of times you're paid a year. If you're paid every 2 weeks, it's 26 pays a year. If you're paid twice a month, obviously that'd be 24 months, 24 pays a year. So take that number, divide it by 24 or 26. and you may come up with the number that you want to have in your paycheck more every single month or every single pay, because you're not having that money go to the IRS. You get to keep it. You get to use it for building your savings, to pay off your debt, to, fund your retirement savings or car replacement fund. You will be a better steward of those funds than the IRS. Here's the kicker. You still have to be very careful, because you don't want to get in a situation where you owe the IRS. Even if you owe $100 to $200, it's not the end of the year. I want to keep it under $1,000, because I'd like for you to be able to handle that out of pocket if you can. That's the idea.
Yeah.
Okay. So tip number 1, not to tip the IRS. Don't get a refund. You take advantage of your money, your income. You earned it. It's not the government's. Number 2.
What about not taking advantage of those legal tax loopholes to morally and ethically reduce your tax burden? Yeah, so
there are a number of them, right? So not doing Roth conversions to reduce your lifetime tax bill. Think about the fact that throughout the rest of your life, you're going to pay a certain amount of taxes. And there are things that we can do today that will reduce the total of what that lifetime tax bill would look like. Roth conversions, Roth contributions are one of those things, especially for individuals who have maybe early years of retirement, or who are in such a low income bracket as to have literally no taxable income. So if you're young, you have kids, you're getting $2,000 a child, or $3,000, I forget what the number is today, child, for a tax credit. Mm-hmm. It's wiping out your entire tax bill. That might be a fantastic opportunity for you to do some Roth conversions to take advantage of that, so that we're not having to pay more for that the taxable conversion, taking taxable money, making it tax-free. It causes that money to be taxed. So if you take a $5,000 Roth conversion, we take $5,000 from the bucket that's never been taxed before. We put it in a bucket that's already been taxed, and that $5,000 shows up on your tax return as a income source. You have to pay tax on it. It's not the end of the world. If you have a large refund, we would just slightly reduce that refund. It reduces your lifetime tax bill. It is a good long-term plan for you. Well, what if you're on the other end of the income or the age spectrum? You may be retired, just Social Security, not taking RMDs yet. You may have no or very, very low taxable income. That's a fantastic time to do the exact same thing, to do a Roth conversion and pay almost no tax. If you have a negative taxable income, that means you may have Social Security, some income, some dividends. That's about it. Your adjusted gross income could be something like $5,000. You're making more than that because Social Security is not really being taxed. Mm-hmm. So, but you have income. It's just not being taxed. So, don't worry. It's not like you're going hungry. But when you take that itemized deduction, or in this case, it would be a standard deduction of $24,000, $26,000, you essentially had $6,000 of income, $26,000 of deductions. You have a negative taxable income of $20,000. That means you could make $15,000 to $20,000 of Roth conversion and pay little to no taxes.
That's a great
I say little to no because that Roth conversion is going to play with how much of your Social Security is taxed. So you have to play with those numbers a little bit. Sure. Be careful with it. But there are ways that you can take advantage of the Roth conversion even in retirement. There are other things like doing a qualified charitable distribution, QCD, for those who are over 70 and a half. Probably going to change that to 72 in the next year or so when they correct the bill. That's the Secure Act that made this little funky age difference, the 72 versus the 70 and a half. But qualified charitable distributions, we have a couple episodes on that alone. So Google QCD in our show search feature on our website, and you'll find a couple episodes there.
So, Tim, one of the things that our listening audience ought to make sure is that they are avoiding penalties. And there's something I've heard you talk about before about a safe harbor rule. Yeah. What is that?
Yeah. So the third way to not tip the IRS is to not get into a penalty status right? I don't want you to have to pay extra money on your tax payment or your tax bill than you need to. So make sure that you're getting your tax situation so it's safe harbored, so you're not liable for penalties. How do you do that? Well, pay 90% of your current tax liability. If you have, say, you owe total tax bill of $1,000 and you have withheld $900, you're going to be fine. No problems, because you would just owe $100. It's 10% of your total tax liability. There'd be no problem. So as long as you've paid 90% of your current year bill, the other caveat here that's not in our notes, that 10% needs to be less than $1,000. Okay. So be aware of that too. So if you owed $10,000 and it was $1,000 owed, you'd be fine. But if it was $11,000 and you'd only paid you only paid 90%, you would get a slight penalty. Okay. On that $1,100 that's underpaid. All right. So that's one way. The other way is to pay 100% of the previous year's bill. So if last year you owed, let's say, $10,000, and this year you pay $10,000, but you end up owing, let's say, $120,000, or however, not 100. You paid, $12,000. So you use some funny numbers here. $12,000. It's $2,000 under withheld. But because you paid all of last year's, you're safe harbored. You're not going to have a liability. That's only for individuals, if you're married, who make less than $150,000 a year. If you make more than $150,000 a year, $150,000 a year, married, filing joint, you would not be safe harbored at 100% of last year's. You'd have to pay 110% of last year's.
Oh, they want more.
They do, because you are
They're
in a higher
anticipating
bracket.
More.
You may be moving higher. So these are the ways that you can avoid paying a penalty on the IRS. Talk to your tax preparer. You can see on the second page of your tax return, the second page of the 1040 at the bottom, where it shows your refund or your balance due. It'll actually show a penalty box. And if there's a number in that penalty box, it means you had a penalty. You made a mistake somewhere along the lines. Typically, for most people, penalties are very small. We're talking about a couple bucks.
Right.
Don't sweat it at the end of the day, but it can be avoided.
Yeah, and that's the goal. Sit down with your tax professional, with your advisor, look at those numbers, and try to avoid these things moving forward, and try to really take advantage of the tax benefits that can come your way. So, Tim, we hear at the Life Financial Group, we hear some common phrases about getting tax refunds, and some of them are quite
excuses
comical.
For getting them, yeah.
And Tim, let's just banter over a few of these right now. What's the first one?
Well, it's a forced savings, Drew. You understand? I'm not disciplined enough to save money. If I save it, I'll spend it. Therefore, a tax refund is a great way of enforcing my savings.
Yeah, I've heard that over and over. I've heard this other one. It's like, I love getting my tax refund because by the time that comes, I can pay off all my Christmas bills. So they spend all their money on Christmas. They're in December, and then they wind up using the money that they get back after they do their taxes to pay off their Christmas bill. So
the problem with that argument is, yes, it's better than certainly better than spending or trying to save that money and end up spending because you have poor discipline. But I would encourage you to build the discipline muscle.
Amen.
Of saving.
Amen.
The IRS should not be your nanny when it comes to your savings requirement. You can build that muscle. One great way of doing it is move it into a different bank account.
Yeah.
Don't commingle it with the rest of your checking. If you have a bigger plate, if you have more income coming into your checking account, you're going to spend that income. So get it out of that income bucket. Move it into a savings account. Move it into a different bank altogether.
Online savings
account.
Use
a high yield savings account online, FDIC insured. That's what I do. I send that money over to my high yield savings account. I use Ally, and it's right now 2%, 2.1% interest, 2.01. I don't know. Yeah. It's a high interest rate right now, and I'm really grateful for that. And I get the interest on my money rather than the government does. And the government, when they return it to you? Yep. Not a penny more. Yep. Not a penny more. What are two of the other ones that we have there? Well, we have pay off Christmas bills, or it's a vacation fund. And certainly I understand that. Again, goes back to the same principle. build that discipline muscle.
Yeah.
It is a muscle that can be developed.
Yeah, and I heard somebody say that it's my home repair fund.
Sure.
I get that money, and I do my home repairs for the rest of the year with that.
The problem I have with that, the second one there, it's paying off the Christmas bills, is a dangerous place to be.
Oh,
because you
slope.
are making assumptions. There are two dangers. There are at least two dangers. First of all, you're making assumptions that you're going to get a tax refund, that something hasn't changed with your tax bill, and instead of getting a refund, you have a liability you didn't expect.
My wife and I had that early in our marriage. We had one of those years.
So not only do you now owe more money to taxes, you now have credit card debt that you're carrying and paying 25% interest on.
Yeah.
That's a double whammy. You don't want to do that. So that also, the second danger there is you're going to be tempted to spend more on Christmas than you would otherwise spend.
Yes.
If it was your money, you actually had it in your checking account, you'd think twice before pulling out all of those Benjamins to buy stuff that your kids are going to forget about and break and not care about in a couple months, couple weeks, couple days, couple hours, who knows?
Yeah, and we need to kind of look at this. What it comes down to is a person that has those types of thinking, processing, and doing in their financial picture, they have poor financial discipline, and they kind of process, if I have that money, I'm going to spend it type thing. Instead, let's take a look at the budget. Let's take a look at the numbers. Let's plan for the vacation, for the Christmas bills, for the home repair fund. Let's build it in, bake it in to your budget, and let's make sure that we don't give Uncle Sam a few extra dollars every paycheck. Instead, let's fund those buckets ourselves.
So how do you protect yourself against the IRS, tipping the IRS? How do you keep yourself from going into that mode where you're giving more to the IRS than you have to?
Well, I think one of the things you just said earlier, Tim, is understanding this safe harbor rule, and getting a good big picture of that and prepare yourself accordingly in that way.
First, I would say I don't think most individuals are in the situation where they're worrying about the safe harbor rule and having a tax penalty. Most people are probably in refund mode. So don't worry about the penalties primarily at this point. If, as you go through your tax journey, as you're reducing your tax overpayment, you want to think a little bit about making sure you're not going too far and now getting on the IRS's bad list, naughty list.
You don't want to get on that naughty list.
Right.
So one of the things, what to do if you change your IRS withholdings and less is taken out, what are some of the things that you ought to do? Because we just talked about it. I think some of these things are common sense things, but we ought to discuss them real quick. I think the first thing is retool your budget so that the money is built into and accounted for within your budget.
Yeah. If you have your income increased by $150 a paycheck and you don't decide to do something with that $150, it's just going to get spent.
Yeah.
Your level of consumption will rise with your level of income. You will have no benefit. You'll be in no better place by doing, this reduction of your refund if you just keep on consuming it all. So retool your budget. My favorite thing to do with it is use it to increase your debt payments to get out of debt by $150 a pay, or that's $300 a month. You just build that in. So it's part of your budget. So it's automatically going where it needs to go, or use it to build your cash reserves, or use it to fund Roth IRAs or 529s or car replacement funds. There's more places, there are more buckets to put the money than there's money to put in the buckets.
Right.
So instead of just consuming it, choose a bucket and prioritize. The goal from a stewardship perspective, if you're not giving what you need to give, increase your giving. That'd be a good first place to go. Secondly, build your savings and your reserves. Thirdly, pay off your debts. Fourthly, build your retirement savings Roth IRA first.
Bottom line is, give those dollars a name. Do not let them be orphaned with no names. When you make those changes, give those dollars a name within your budget. So let's kind of wrap this up here. Part of our goal for you, our listening audience, is when it comes to taxes, don't be lackadaisical. about them. For it could impact an audit coming upon you, unlikely, but possible. And it can impact your monthly income and distribution of that income. And it could increase your monthly generosity to your church. You could so choose to increase that. It also, for those that are taking as many tax breaks and advantages allowed, it may allow you to be much more generous to your local church and other ministries due to using the benefits of charitable giving as laid out in the tax code. Render under Caesar's what is Caesar's, and not a penny more. A good steward will investigate, tweak, change, modify what they need to do in order to pay their fair share on time, every time, and not a penny more.
We'd like to thank you for joining us today on the Stewardology Podcast. Thank you so much for taking your valuable time and joining us on this episode. Send us your questions and ideas for future podcast episodes. Go to stewardologypodcast.com/ideas and share your insightful, helpful, and very creative questions. You'll notice that in our next episode next week, we'll actually be tackling one or two of questions we've gotten from you, our listeners. Don't forget to take advantage of your free stewardship reviews as well. Go to stewardologypodcast.com/review to request your free stewardship review. Consider giving us a rating and review on your favorite podcast catcher, and go to our website for show notes and more helpful information from today's episode. Until next time, may God bless you, and remember to be generous unto the Lord, but not unto Caesar.
Thank you for joining us on the Stewardology Podcast, where financial stewardship and theology meet. We'd like to help you take your next steps in biblical financial stewardship. First, subscribe in your podcast provider to get the newest episode delivered to you every week. Next, follow us on social media and visit our website at stewardologypodcast.com. There you can find our social media links and our entire episode archive. Remember, some trust in chariots and some trust in horses, but we trust in the name of the Lord our God. See you next week on the Stewardology Podcast. Securities and advisory services offered through Genius Wealth Management, member FINRA and SIPC.